traders, FX Collector here. So today is Wednesday. It is March 18th. So how is everybody doing today? Hopefully everybody's doing fairly well. It is FOMC day, so kind of a big day in the markets potentially. They are saying that there will be no change of rates, so that's kind of the only thing. I mean, are they really going to change rates? Will they change them? Will they not change them? I guess we'll just have to wait and see. So anyways, yeah, let's start off as always. We're gonna start off by looking at the US dollar index. We're gonna see if there's anything going on with that. Potentially, if we can figure out what the US dollar index is doing, we're gonna be able to hopefully see if we can figure out what the dollar pairs themselves are actually doing. So anyways, yeah, let's see here. Let's start off with the US dollar index. I want to go up to the weekly time frame and I want to go over to the DXY for just a minute because the DXY is definitely potentially a very, very clear pattern. I don't normally analyze the DXY because it is literally the exact same thing as the euro dollar, but in reverse. The DXY is 56 or 57% weighted to the to the euro dollar. So it's pretty much exactly the same thing as the euro dollar, but in reverse normally. So not really something I normally really analyze just because of that. And if you look at the US dollar index, it is very similar, but there is definitely differences between them. I will say though that the DXY seems a little bit clearer for this weekly time frame pattern. My mentor used to have a saying. He used to say that what you need to do is you need to search for clarity, right? If the clarity is on the weekly, the monthly, the daily, the 4 hour, the 1 hour, even if the clarity is on the 5 minute time frame, if you can find clarity, then you need to take that clarity and you need to apply it to whatever time frame you're looking to trade on. So if we think that the weekly time frame is potentially a very clear pattern, then we need to take that and we need to apply it to all the other dollar pairs. Now, we're all here, hopefully, because we have FOMC news coming out. We have FOMC interest rate news coming out in about 26 or so minutes. So, in about 26 or so minutes, we got FOMC. The current rate is 3.75, and it's forecasted to come out at 3.75. Um, some of the members in my group posted a chart this morning saying that there's like a 95 or 95.95% chance that they're not going to be changing rates. So, most likely there's not going to be a change of rates. If they do change rates, that's when potentially you could have a big volatility move, because if there's a 95% chance, people say that there's a 95% chance of no rates change, and then they decide to change rates, that's when you're potentially going to have a good move in the market. Excuse me. So in 25 minutes, we got that coming out. And then after that, we got a press conference, which I'm pretty sure it's still Powell talking. So we got Powell coming on 30 minutes after that. After the news comes out, I'm going to take requests like it's a normal live stream. So what we're going to do for the next 25 minutes is we're going to look at the dollar index and we're going to look at the dollar pairs because this news obviously affects the dollar more than anything. And then after the news comes out, we'll kind of reevaluate the dollar pairs, see what we can figure out. And then the half an hour in between, 6 p.m. and 6:30 p.m., I'm going to take requests from the people in the chats. So if there is something you want me to look at, this 30-minute period right here is when we're going to do that. Because at 6:30, we definitely do want to watch the press conference to see if we can figure out, because potentially that's when the market could make a move and actually hold a move, is especially during the Q&A version. If you actually click on this, it actually talks about the Q&A part of the press conference is sometimes when you get the biggest moves. So, anyways, let's start off real quick on the weekly time frame. I don't want to spend too much time on it because anybody that's been watching my videos for any amount of time probably already knows what my weekly time frame analysis is. I like to change colors here and make it really big just because I think if I do that, it really sticks out, kind of like a sore thumb. It sticks out like a sore thumb. So the impulsive moves are yellow. So first of all, we have an impulsive move down, and then I'll make the corrective moves red or pink. I'm a little colorblind, so don't mind that. So that is definitely a three-wave corrective move. And then even though this isn't a very big move right here, it is definitely impulsive. So we have impulsive, corrective, impulsive for the wave W. And then we have impulsive up, and then we have corrective down. One, two, three waves down. That, by the way, is like a perfect ABC pattern right there, like a traditional ABC right there in the middle. And then if we switch back to yellow, because we have another impulsive move up right here, so we have impulsive, three waves, impulsive for the wave X. So the wave W and the wave X are extremely clear in my eyes that it's three waves down, three waves up. So that's why I have this labeled as a WXY pattern. Now, if this was actually breaking structure at a Fibonacci level, which it's not, but if it was, I would just say, oh, this is a flat because you could have a 3-3-5 pattern, right? So three waves down, three waves up, five waves down, and then a break of structure would be the end of a flat and continuation of the uptrend. But because it's not turning at a fib level, I'm pretty confident that this is a 333 pattern, which is a WXY pattern. So we have impulsive down right here, which in my opinion, I think that ends right here at this low. So we have impulsive down. And then I'm going to draw out the correction with more detail. I didn't really do much detail in this one, but we have one, two, three waves up. Very clearly, one, two, three waves up. Then we have one, two, three waves down. Very clearly, three waves down. So this is potentially a 333 pattern or a 335 pattern for the wave B, because a wave Y needs to be three waves, just like the wave W and the wave X was three waves. So that means that this is potentially going to go up to where I think is 104 for an expanding ABC, and then it's gonna make another impulsive down like this. Whoops, I wanted to change colors because yellow is impulsive. So this is my forecast on the dollar, and this has been my forecast on the dollar for quite some time now. If I go back to the normal size, a wave Y is supposed to be a wave A, impulsive down. It's supposed to be three waves of B, which is what I have. And then it's supposed to be another impulsive down for wave C, and that would bring us down to either the 78% Fibonacci retracement or possibly the 90% Fibonacci retracement before we ended up potentially making a big push up. This is the weekly time frame, so this big push up is something that's probably not going to happen for like maybe 2 years. This is potentially like at least a 2 year, maybe a 3 to 5 year forecast because I think once the pullback is over, it's going to go up and make new highs. I think we're going to see new highs on the DXY probably someplace between maybe 4 to 5 years from now. So this is like a 5 year forecast right here. So it's obviously a very, very high time frame forecast. But if I think that the dollar is currently going to go up to about the 104 area before it starts to go down, then that means I would expect the euro dollar, the pound dollar, the Aussie dollar, the Kiwi dollar to go down while this is going up. And I would expect the dollar CAD and the dollar Swiss to go up while this is going up. The dollar yen is more of a yen pair, doesn't really follow the dollar index quite so much. And gold and silver and stuff like that definitely don't follow the DXY quite so much either. This pretty much only applies to the dollar Swiss, dollar CAD, Kiwi, Aussie, pound, euro, dollar. So basically, we just spent about 10 minutes looking at nothing but the dollar index and only on one time frame. And because of that, I pretty much know what my main direction is on all six of these currency pairs, except for gold, because gold, like I said, doesn't care about the dollar index. So going back to my main dollar index, which is the one I prefer to analyze because I have way more labels on here. Here's your one, two, three waves up. Here's your one, two, three waves down. I think we're in the middle of a wave three, which is either going to look like this for a running and then down, or it's going to do what I just drew on the higher time frames, which is a higher low, higher low, higher low, make a wave four. So here's your wave one, here's your wave two, here's your wave three, here's your wave four, and there's your wave five. And keep in mind that this whole move up right here is probably going to take us right into probably July or August. I think around July or August, the US dollar index is going to be around 104. And then it's probably, August, maybe September or something like that. It's maybe not August because August can be a very slow month, but maybe September or October or late July, it's going to start a new downtrend for the big wave C. Like I said, I spent a lot of time analyzing the dollar index because if I'm right about this dollar index, then I know exactly what direction to be trading in on all six of these currency pairs. Without even looking at the euro dollar, I know pretty much what I need to do on the euro, the pound, the Aussie, the CAD, and the Swiss. So, anyways, going to there, I need to start off real quickly on the higher time phase, just because I need to show everybody something on the high time phase. The weekly time frame, the euro dollar broke structure this last week. This is the first break of structure we've had since the beginning of 2025. So for the last year and what, 3, 4 months, this is the first break of structure we've had in about 1 year and 4 months. That is extremely significant in my eyes. Very, very significant. That means that we're either going to now make an ABC pullback that would look something like this, or if this really is a wave C, like I think it is, then this is going to be a downtrend. I think the euro dollar potentially could go all the way back to parity. within by maybe August or so. And then if we look at the pound dollar really quick on the higher time phase, we do not have a breaker structure on the pound dollar. But we definitely do have a five-way structure. We definitely got an impulsive. We got a very running ABCDE pattern, and then we got another impulsive. This looks to me like an ABC. This is not a 1, 2, 3, which means that this is probably going to turn into a downtrend. I think there's a chance that the pound dollar could even go all the way down to like 1.04 to like 1.06 maybe by August or so. And then the Aussie dollar, the Aussie is quite a bit different just because it's a risk on, risk off a little bit more. But this potentially could make a 78% pullback, maybe going all the way down to 0.66 before it starts an uptrend. I know I'm only looking at the higher time frames, but these higher time frames give me a lot of good direction. The US dollar CAD, it makes total sense with the US dollar analysis. We got impulsive up, we got 1, 2, 3 waves down. We're going to get another impulsive up to the 100% Fibonacci extension, probably putting us into August, September, and then we're going to get another downtrend like that. Makes a lot of sense to me. US dollar Swiss is also a little bit different just because it's a risk off pair. I know it's hard to see because of all my labels and stuff, but I think this is a WXY. This is another WXY, so three waves of A or three waves of W, three waves of B or three waves of X. Now we're going to get either 1, 2, 3 waves of Y or we're going to get 5 waves of C. So the dollar analysis that I just said, I just lined it up with the euro dollar, the pound dollar, the Aussie dollar, dollar CAD, and dollar Swiss, and it makes sense on every single one of these pairs. My US dollar analysis makes sense on every single one of these pairs, which is why I'm pretty confident about that dollar analysis because the pattern, the alleyway pattern on the weekly time frame on the dollar Swiss, the dollar CAD makes sense on the Aussie dollar, the pound dollar, and the euro dollar. And that weekly time frame analysis makes sense if you compare it to the US dollar analysis. So that's why I've been pretty confident about this analysis. Now, what's going to happen today at the news? That's the question we're all worried about. Right now, we got about 15 minutes to try to figure out what's going to happen today. One thing you need to kind of keep in mind real quick is that the dollar index is still not broken structure. This move down definitely could be a pullback to this move up. I still think, like I've been talking about this all week with my members, that at the end of an ABC, you normally don't get a big pullback until you break the wave B structure. We haven't broken the wave B structure yet. I think there's a good chance the dollar can make a higher low and push up maybe to this 100% Fibonacci extension. That's going to be the resistance for wave 3, wave 4. Because I think this is a 1, I think this is a 2, and I think we're still in a wave 3. I don't think we're actually going to start the wave 4 until probably we break the structure and then maybe retest the 100% for the wave 5. And yeah, so anyways, that's my main analysis on the dollar. On the 1 hour time frame, right before the meeting, I was discussing it in my group chat on Discord. Um, like I say, I always say, if you ever are interested in joining my website, I have a group chat on Discord where we, share our charts and stuff like that. And I was discussing this with a few minutes ago with people there. If you are interested in that, check out my website, fxpepcollector.com. I'm not gonna promote myself too much, but it is only $30 a month. It's extremely cheap, and you get a lot of benefits, including following along with every single one of my trades if you want. That's why I like to call it learn and earn. Because if you want to follow along with my trades, you definitely can. But the point is definitely to learn how to trade, not to just follow somebody else's trades. On the 1 hour time frame, the dollar index kind of looks like a 1, 2, 3, 4, 5 here. I have two possibilities. This is an A, and then this is an A of B, this is a B of B, and this is a C of B, and this is a flat, a running flat, and now it's going to go down for C. So an A, B, C, a B, and then down for the C. So A, B, C, a B, down for the C. Or possibly it turns into an expanding, which means it goes up, takes up this high, and then reverses down like that for the expanding ABC. So this is definitely what the 1 hour time frame looks like. The problem I have with this analysis is that the weekly just looks bullish. The daily just looks bullish. Let's see, are we at a Fibonacci level? That's what's important to me right now. Yeah, we definitely did get a Fib bounce. We bounced right out to 61% Fibonacci. My second analysis is that we are overcomplicating this, and this right here is the complete pattern. This is a complete correction. We had a break of structure already today, earlier today. Now we got the break of structure. Now we got the retest. And now we're getting ready to go up for wave three at the news, hopefully. That's kind of what I'm hoping happens at the news. 1, 2, 3 pattern. I'm actually flat right now. I'm not in any trade, so I don't really have any skin in the game. Sometimes when you're in a trade, potentially you can have some skin in the game, and that can cause you to potentially, like if I was short the euro dollar, obviously I'd want the dollar index to go up. So right now I'm not in any trade, so it's not like I have a bias based on a trade that I'm in. So I think there's a good chance the dollar's going to go up. So that means if I look at the euro dollar and all the other dollar pairs, we need to apply that knowledge to this. The euro dollar also broke structure down today. I think this is potentially an ABC correction. I mean, it did overshoot the 50% a little bit, but it definitely turned at the 50% with three waves up. Then we got a break of structure today. I think this is potentially going to maybe mess around a little bit, but I think the direction is down. I think the euro dollar is going to keep going down. Kind of the same thing with the pound dollar. Kind of turned right in the middle of two waves, but I mean, we definitely got five waves up there, correction, and then we definitely got at least five waves up here, and then we got to break a structure to the downside. I think this is just retesting. I think we already got the break, and it's just retesting for another push down, is what I'm thinking. Based on my dollar analysis, this is exactly what I think is going to happen. And then if we switch to the Aussie dollar, same exact thing, right? Aussie dollars bounced off a fib level, not really a three-wave structure, but definitely, higher highs, higher lows, higher high, higher low, higher high, higher low, and then a break of structure. Definitely a clear break. I think there's a good chance this is just a break of structure pullback. Maybe it will spike a little bit. Maybe it will even go back up and test the highs at the news. But I'm betting on down. I think the Aussie dollar is going to go down. We got to save a little bit of time for gold because gold is usually completely different than the other pairs. Yeah, the dollar CAD, I mean, my overall bias on the dollar CAD is that it needs to go up and break this structure right here before we see too much of a significant pullback. So my bias on the dollar CAD is definitely still up too. But when you go down to the 1 hour time frame, it looks like impulsive down, corrective up. It looks like it could go down before it goes up. But that doesn't really line up with my other dollar pairs, which is why I'm thinking that maybe this is a 1, 2, 3, 4, 5 pattern. Maybe this right here is already the end of a pullback, and then this is like a regular flat. This is like a wave one. This is a wave two, and this is going to go up for a wave three. So that's what my analysis is on the US dollar CAD because of my US dollar analysis. Because of my US dollar analysis, this is what I think is going to happen on the dollar CAD. Even though if I was only analyzing the dollar CAD, I would say, oh, this is an A, this is a B. The news is going to come out, it's going to go down, make a C. And then maybe later on reverse back up. And then the dollar Swiss. Dollar Swiss is already breaking structure, and that is because the Swiss, if you go and look at the Swiss pairs, which I'm not going to analyze the Swiss pairs, but if you go look at the Swiss pairs real quick, Swiss pairs, the Euro Swiss is going up all day long. The Pound Swiss has been going up all day long. The CAD Swiss is going up. The Aussie Swiss is going up. The Kiwi Swiss is going up. The Swiss yen is going down. What does that mean? That means that this push up on the dollar Swiss is more because of the Swiss, not the dollar. The Swiss is affecting the dollar Swiss more than the dollar is right now. So that basically means if the news is bullish the dollar, this might, make a pullback, but it might just potentially keep on going. We'll see. This one I could almost picture being like an expanding flat also. Like this is your expanding flat right here, then it goes down like this. So we'll see what the short term is. I'm very confident about my weekly, daily time frame analysis, but what's going to happen today? Is it going to spike reverse? Is it going to go down and take a fib level before it goes up? Is it going to go down for a day or two before it goes up? You could be right about your weekly, daily time frame analysis and still be wrong about the very short time frames potentially. One thing I wanted to do on gold real quick, just because I know there's so many gold lovers in the group. I'm actually not a gold trader, so if you do join my group, we analyze gold a lot, and we have a lot of good gold traders in the group. But I personally don't trade gold because I am from the United States, and you cannot trade gold in the United States on a margin broker. You can trade it on a prop firm or a futures broker or something like that, but you cannot trade it on a margin account. So my forex broker, I cannot trade gold if I live in the United States, so I never traded gold. Not because I don't like it, even though I don't really like it. But anyways, on the monthly time frame, I just want to show you that this is a 1, this is a 2, and this is extremely clearly a wave 3. If we really are starting this wave 4, which we really still have no evidence that we are, then this wave 4 is going to, in the time scale, The time scale is down here. This is the time scale. This is the price scale. The time scale will take about the same time that it took for the wave 2 to play out. This wave 2 is roughly 500 days, calendar days. So if this really is starting a wave 4, then we're going to be in a wave 4 for about 500 calendar days. And because this wave 2 is a traditional ABC pattern, this wave 4 is very likely going to be a complex pattern, like a triangle, a flat, or like a WXY, like an ABCDE pattern. So if we really are in a wave 4, then we're probably due for about 500 calendar days worth of very messy patterns. This could be like an 1, 2, 3 down, 1, 2, 3 up, 1, 2, 3 down for 500 days, and then end up going up later on. Or it could make some sort of like a triangle, like an expanding triangle or something like this. Something like this. It could make like an ABCDE pattern. There's a lot of different possibilities. But on the daily time frame, my main analysis is still that this is a wave 3 and that this is going to keep on going. I think it's going to go down to $4,500 and then potentially start another 3 waves up because I think we're potentially in a complex pattern. So I think this is going to make 3 waves down for A and potentially 3 waves up for B. And then it's either going to make 3 waves of C, 3 waves of D, 3 waves of E, or it's going to be a WXY, or who the heck knows. But as of right now, I am definitely still very, 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 very bullish. Now, gold potentially could go up at the news. We made a very impulsive move down today, and if you've been watching my videos on gold, I put out PM videos every single night for $8 a month. You can get my PM videos every weekday, which is for gold, the euro dollar, the pound dollar, and the dollar yen. Every night I make videos that are about 1.5 minutes to 2 minutes long. But if you've been watching even my morning video that I put out, I've been saying, look for shorts on gold, look for shorts on gold all week long. I've been saying, look for shorts on gold, look for shorts on gold. Have you been looking for shorts on gold? If you have been, hopefully you went short. I don't trade gold, like I said, it's not my pair, but definitely a beautiful trade. Now what we need to do is throw a Fibonacci retracement on there, right? Gold is currently in a downtrend unless it breaks this high right here, unless it goes up and breaks this green line. Gold is still in a downtrend unless it breaks that line on the daily time frame. So this thing potentially is in a pullback right now. Maybe it'll go up to a fib level and then go down. So my forecast for gold is maybe it will go up a little bit, but it's probably just going to go to one of these 3 fib levels and continue down. I don't even think it's going to go up to the 78% because if it really is a wave 3, then most likely it's going to maintain momentum. Most likely it's only going to make like a 50 or maybe even a 30% pullback. I mean, this potentially could already be 3 waves up to the 38%, and they potentially could just keep on going down at the news. So we do have the potential to have quite a bit more down on gold. Like I said, my forecast on gold is roughly $4,500 on the daily time frame. Like I've been saying, I mean, there is a possibility that this is an ABC and it goes back up, but I think the possibility of that is slim. I think it's going to keep on going down personally. I don't really think that it's going up. So anyways, that's what I think about that. Like I said, if you haven't done so already, we got news in 5 minutes, but if you haven't done so already, definitely do check out my website. It is fxpipcollector.com. It is only $30 a month. It's a very, 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 very cheap membership. Many traders charge a lot of money because I don't want to get rich off my memberships. I want to get rich off my trading just like everybody else does. I just want to build a community of like-minded traders that are willing to help each other out. I do share every single trade I take with the group at the exact time of entry. I'm currently doing a challenge where I'm trying to turn 1,000 euros into 10,000 euros, which you can watch my videos on YouTube if you want to follow along with that. I make short videos on YouTube and for Instagram for the 1,000 to 10,000 challenge. If I can turn 1,000 euros into 10,000 euros in maybe 3 months or so, I'm going to try to turn 10,000 euros into 100,000 euros, and then eventually, maybe next year, I'll try to turn 100,000 euros into 1 million euros. And my whole thought process is, most people can afford to start off with, 500 or $1,000 or euros. You don't need to have, a $100,000 trading account. And you don't need those stupid prop firm accounts either. Those prop firm accounts are just robbing your money. You could take that $500 and put it into your own personal account and potentially turn that into $5,000 if you're a good trader and you use something like the Kelly criterion formula in order to figure out how much risk you should be uh, you should be risking per trade. The amount of money that people spend on those prop firm accounts, you could start your own account and you potentially could make way more money, and you won't have to worry about losing your account because you broke some stupid rule that is hidden in the fine print. So, anyways, we got 3 minutes until news comes out. We got FOMC news coming out in a few minutes. After the news comes out, we'll reevaluate the dollar pairs, and then I'll take requests from people in the chats. So after the news comes out, if you have something you would like me to look at, then definitely ask, and I'll look at anything. Somebody wants me to look at the pound yen and also Bitcoin, so I'll definitely do that. And I can look at anything. We'll spend about 30 minutes just looking around at different pairs. If they don't change interest rates, it might not be a big deal. If they do change interest rates, it's definitely going to be a big deal. I think that the fact that they're not going to change interest rates and the fact that people are worried that they're not even going to lower rates again potentially this year is actually pretty bullish the dollar, which also lines up with my US dollar analysis. So I think there's a pretty good chance that we will see the bullish dollar analysis, just like I've been saying. Let's watch the euro dollar just because that's a good pair to watch in my opinion. Let me make sure I'm logged into my trading account just in case I do get suckered into entering a trade. Like I said, every single trade I do take, I do stay with the group at the exact time of entry. I really don't like to call it a signal service, even though many people do use it as a signal service. I don't really like to think about it like that because nobody is ever going to become rich by following somebody else's trades. You're only going to become rich by learning how to trade and having your own strategy and having your own system. So make sure I'm logged in my trading account. We got 1 minute and 12 seconds until news comes out. And like I said, after that, we will take requests from people in the chats. And then once that's done, we're also going to try to, we're going to watch the Powell speech, which I got to find the Powell speech. I always forget to look that up prior to starting these live streams. All right. FOMC, what do we got here? We got 38 seconds. I'm just getting the FOMC speech queued up for afterwards. Then we'll see what happens. You got 15 seconds until news comes out. I personally think there's a good chance that the euro will go down, but that doesn't mean it won't go up first. Here we go. Oh, I'm getting some alerts already. I use a ton of alerts. Okay, whoops. Sorry, I just had the Powell speech queued up. So afterwards, we can watch this. Where's the news? No change in rates? Yeah, no change in rates. My forecast is that the dollar's going to push out, the euro dollar is going to push out, take out this high, and probably start a downtrend, is what I think could happen. I might get suckered into trying a little bit of a trade, but we'll see. Thoughts don't even look like they're working. Give it a couple minutes just to see what happens. You really can't judge a whole lot within the first. Any news event is like this, in my opinion. You really can't judge a whole lot within the first minute or two. More times than not, within the first couple minutes, you're not going to get the real direction, or it's just going to be a volatility spike, a liquidity grab, whatever you potentially might want to call it. And the chart is frozen. It's not frozen on MT5. It's frozen on TradingView though. That's nice. Too many people trying to place orders all at once. Not really doing a whole heck of a lot, is it? I think I'm gonna put a little play order in. It's not gonna be a big order, but I am gonna put something in. Give me a few minutes. I just wanna place an order. Like I said, every single trade I take, I do share with my group at the exact time eventually. So if anybody is ever interested, definitely check out my website, fxpipcollector.com. It's very, 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 very cheap. The euro dollar is kind of my main pair. That's kind of the pair that I normally do trade if I do. I mean, I trade at about 16 different pairs, but the euro dollar has always kind of been my favorite pair and my most traded pair probably. I'm gonna put in a limit order. I'll use a little bit of a tighter stop than that. I want to risk a little bit less because it's kind of a play order. I risk like 50% of what I would normally risk. Oops. Like I said, in a couple of minutes here, I'll take requests and we'll start looking at other pairs and other things. I'm just putting in a limit order for myself. Anybody that does want to follow along is definitely more than happy to. But like I always say, it's not a signal service, but you're more than happy to follow along if you would like to follow along. All right, I put in a little bit of a play order. So let's see what happens with that. It's a limit order on the euro dollar. Now let me switch back so I can see what people are saying. See you later, buddy. All right, let me see. Let me look at some things. Like I said, if we're gonna spend the next, we're gonna watch the Powell speech when that starts. The Powell speech will start in 25 minutes. I got that all queued up right here. Starts at 2:30 Eastern Standard Time or 6:30 London time, GMT time. So we're gonna watch that together. But we got about 25 minutes until that starts, so we're going to spend that time looking at pretty much anything anybody wants. So let's start off on the pound yen, just because that is what was requested first. Like I was saying this morning, if this was the end of an ABC on the pound yen, I would expect it to keep going down. I would have expected to see a break of structure before we got a significant pullback. The fact that we do have a significant pullback already makes me think that it's actually going to go up and take out the previous highs. So I am long on the. I'm not long. I'm looking for logs, and I am bullish on the pound yen. I would definitely be paying attention to Fibonacci extension levels for areas of resistance and areas of support. Well, resistance in this case because we're going up. As long as it doesn't take out this low right here, we are definitely in an uptrend right now. So as long as it doesn't grab this low, even if it does start a move to the downside, I would just throw my Fibonacci retracement on there, and I would just look for longs after the after a pullback. So definitely still looking for longs in an uptrend for sure. So anyways, definitely bullish on that. As long as it doesn't break this low right here, which is right around 212, I would definitely be looking for nothing but longs on the pound yen. I could take a quick look at Bitcoin. Bitcoin is definitely not my pair, but we actually were looking at some crypto yesterday during my Zoom call. Twice a week, I do live streams for my premium members. I do a Zoom call, usually almost 2 hours long. And yesterday, so Tuesday and Friday is when I do that. On Wednesday, I do a YouTube live stream, but the stream I do for my members is a little bit different, just because I do a lot of teaching and doing these. It's not just looking at pairs. I try to teach while I look. I think there's a good chance that we're going to get one more push down. I think that Bitcoin needs to go down to 57,500 area because that's where the next Fibonacci is, and it never did hit a fib level. So what I would be doing is I would be watching these Fibonacci retracement levels. I would put my Fib retracement from here to here, and all these Fibonacci levels right here I'd be looking at as possible resistance. Now, just because it bounces from a fib level like it just did, it just bounced from a fib level just now, today, doesn't mean that it's turning. What's going to tell you that it's turning is seeing it turn at a fib level and break structure at a fib level. Oops. So let's go to a shorter time frame and put this on. like the 4 hour. Zoom out a little bit. It's not just a bounce at a fib level, it's a bounce at the fib level in the break of structure. Now, often we do enter on just a bounce, but if we enter and it doesn't break structure, then that's kind of a good red flag that it's not going to keep going down. I guess your structure is probably right around here, right around the 70,000. So if it makes a higher low, if it doesn't break that 70,000 to the downside, then I would just look at this move down as possibly a pullback within the move up. If it does break this low right here, then I would become bearish, taking it down to about 57, 58, 57.5, which is the 61% Fibonacci retracement on the higher time frames. So yeah, definitely still doing that for sure. Looking for shorts on that. Yeah. So anyways, let's see. Yo Aussie, please. Yo Aussie. Yeah, let's go back to the Yo Aussie. There was a few people in my group that went long the Yo Aussie today. I was long the pound Aussie the other day. I got out though because the trend is still pretty heavily down. Definitely still very bearish overall on this. But it really does look like it needs to go up one more time. It's just the question is this just another pullback, right? Because the structure is right here, so it's just like another three-way pullback within a downtrend, or is this really going to end the wave three and potentially go up and do something like that? Kind of hard to really know for sure, but I think we got the end of the cuts, and like I said, I just don't know if it's an A, B, C, or whether it's a 1, 2, 3. I just don't know if it A, B, C, 1, 2, 3. Who knows? What we need to do is throw out Fibonacci retracement on the daily, right? I don't really think you have to know either. I think that's one of the biggest problems with people that learn Elliott wave is they think that they need to know everything. You don't really need to know, right? Because if this goes up and makes a wave C, what would you do on sort of time frames for the next few days? You would look for longs. If this goes up and makes a wave three, then what would you do on sort of time frames? You would look for longs. So why does it matter whether it's a wave three or wave C? In my opinion, it really doesn't. So I think it's going up. I think this is now in an uptrend. I think we're going to go up either to maybe to 68 for a wave C and then turn back down, or it's just going to keep on bouncing from fibs, making higher highs, higher lows, and eventually go up and break daily structure, which would prove to me that the wave three is complete on the daily time frame, which so far it hasn't done so. Let's see here. So that's what I'm looking for on that. Let's look at the DAX and the NASDAQ. I did recently start trading a couple indices. I started trading the US 30 and I started trading the UK. I didn't want to trade more than one US industry because they're all so correlated that they're pretty much all the same thing. And I didn't want to trade one, the UK and the DAX because those are also pretty correlated. So I just wanted to pick like one European, even though I'm calling the UK European, it's technically not. But I wanted to trade one European industry and one US industry only. So I just recently started trading the Dow and the UK 100. But I will look at anything and give you my opinion. Indices right here. The DAX, right? DAX is next. Yeah, DAX. A lot of a lot of indices definitely look like they found some kind of a top, don't they? Man, I got my Fibonacci extension, and we definitely had a pretty big reaction at a fib level, didn't we? Oh yeah, that's okay. Now I remember. This is likely an A. This is probably a B. I do think we're going to go up to like the 50 to 61% for a C, and then I think we're going to go down again. So I think it's going to potentially go up, but I think that move up is potentially just a pullback within a downtrend. But short term, it's probably not finished with this move down, is it? Guys, go to 2 hour to zoom out a little bit because I have the way I have the settings on this. Whoops. So I'll throw your Fibonacci retracement on there. Seems pretty clear, honestly. This is very likely a wave A right here. This is very likely a wave B right here. We're probably already in a wave C. I would expect it to go down to like the 60 or the 78 and then start another push up to the 61 or the 78% of here. Seems very clear to me, honestly. ABC. Definitely does seem pretty clear for the most part. Let's see here. Mm. So, anyways, what does everybody else want to see? The NASDAQ or NASDAQ? Just a second. I'm just looking for. Mm. Okay, so yeah, let's check out the NASDAQ. So, anyways, let's go to 1 hour real quick just to see if there's any structure. There really isn't, is there? You kind of got to go down to the 30-minute. Probably a pretty good chance that we're going to see another move down at some point. I think it's good. Yeah, I would definitely still be looking for shorts probably. Let's look at the Nasdaq. It's pretty similar to. They're all pretty correlated, really. I was thinking that the Nasdaq was potentially in a wave five. I was thinking that all of them were in a wave five, honestly, but it looks like a potential wave five. We still haven't broken structure though, and that's the part that makes you think that maybe there is a chance that it just keeps on going up because there's still no break of structure. No break of structure means that there's always a chance that it just keeps on trending. You can't assume things are over. Like I said, I think that's one of the biggest problems with Elliott wave traders is an Elliott wave trader will put the Elliott wave labels on a pattern and then they're gonna assume that things are over. And you can assume something's over, but you can't really say it's over until there's proof, and you can't really say that this uptrend right here is complete until it breaks this structure right here. I personally think that it will break structure, but there's also a chance that it just rejects it and goes back up. We don't really know. That's the problem with heavyweight traders, in my opinion, is you don't know what's going to happen, but you think you know what's going to happen, and because of that, you end up making trades based on what you think you know, even though usually what you think you know is not even correct. Wow, the Nasdaq is actually quite a bit different than the U.S. 30. Wow, I like the U.S. 30 a lot better. I think this is an A. I think this is, but that's the man. This one's different, isn't it? Yeah. Maybe it's just going to go down, grab some liquidity, and then start up. It looks like it should go up again like the other ones. ABC, potentially to like the 61%. The question is it going to go down, take out this low, or just take out this low? Because the other one looks like it needs to go down a little bit more too. So this will probably go down to take out this, maybe take out this before it goes up. So I would expect something like that, probably, most likely. We still got about 15 minutes until Powell starts talking. So if anybody has any requests, definitely put them in the chats. I'll be more than happy to look at anything. I don't mind looking at individual stocks, cryptocurrency. I can look at basically anything. It doesn't really matter. Indices, obviously, commodities, silver, gold, oil, platinum, palladium, cryptocurrency, obviously, forex pairs. Speaking of forex pairs, oh man, did we get picked up on that order? Didn't, did we? Hopefully, it doesn't just keep pushing down. That's the only reason why sometimes I don't like limit orders, because sometimes you won't get picked up and then it'll take off without you. Yeah, I'm gonna give it a few. Oh boy, I don't know that pound dollar. I put a limit order on the euro dollar and it didn't get picked up. I mean, it's still a good chance that it will though once Powell starts talking. All the rest of them look like they could keep going now, so that's the problem. US dollar Swiss, man, that would have been the one to get in because we have a weak Swiss and we got a strong dollar. The dollar Swiss definitely would have been the one to potentially take. Yeah, gold, not really doing anything, is it? Dollar yen still fairly bullish for the most part. Yen pairs didn't really do much either. I kind of stayed a little bit out of the market. I'm not today. I'm not really too much of a fan of trading FOMC days. I used to always trade them, but I keep a trade journal. I journal every single trade I take, and looking back at my trade journal, I was like, man, trying to trade this news is really not doing me any benefits. Sometimes you would get like a big risk to reward in a couple minutes. Sometimes you would get in a trade and it would do almost nothing, kind of like potentially what would happen today if you get in. I guess we're gonna have to wait and see what Powell says though, because he's gonna be the determining factor, isn't he? So, no more requests. Anybody have anything they want me to look at? Or is everybody just waiting for Powell? I thought Powell was almost finished, but apparently he's not. He's still got some more time left. We got a little while. We still got 12 minutes or so until Powell starts talking. I have a feeling that people are not really quite so concerned about this, and they're more concerned about what's going on, which I don't want to say just because I don't want YouTube to demonetize me or whatever. But the market's a little more concerned about the WAR thing that's been going on, So the scheduled news that's been coming out hasn't really been the big market mover lately. And by the way, has anybody seen all the news that has been coming out this week? And really, it's not even moving the market. It's other things that have been moving the market. We had Canadian interest rate this afternoon, which didn't really do a whole heck of a lot. We had U.S. interest rate just now. Tonight we have, right? Yeah, tonight we have yen interest rate, which they're not planning on changing either. Oh yeah, I can take a look. Sorry, sir, I just saw that. Yeah, I can take a look at the Kiwi dollar for you for sure. We got interest rate for the yen tonight, which possibly we're waiting for a turn on the yen pair, so maybe that could be a decent turn. We'll see, but not really a whole heck of a lot going on, is there? It's the things that are not on the schedule that have been the problem. So, and we also have the Bank of Switzerland. We has interest rate this week, and we got the UK doing interest rate this week. So almost every single country that we follow, I think. Well, except for maybe Kiwi. Kiwi's probably the only one that's not doing it because Europe's doing it too. Europe has their interest rate news. Switzerland has their interest rate news. Yen has their interest rate news. US has their interest rate news, and Canada has its interest rate news. So one, two, three, four, five, 5 or 6 out of 7. Yeah, that's pretty good. Almost every single country we follow. Let me take a look at the Kiwi for cerds. I don't normally analyze the Kiwi just because it's so much similar to the Aussie dollar. Oh wow. Man, maybe this isn't going to make that big old WXY like I was forecasting on the Aussie and the Kiwi. The Aussie still looks like it potentially could do it, and it looks like it just wants to make a pullback, but boy, that Kiwi doesn't really even look like that anymore. That Kiwi looks like it ended in ABC correction and now it's back into the downtrend. It looks like it just wants to keep on going down to these lows, which I think would line up with my dollar analysis because I'm bullish the dollar, so potentially that would line up with my dollar analysis pretty well. We already got our Fibonacci retracement on the last move. We did get a 78% Fibonacci bounce. As you can see, price definitely did bounce at the 78%, but it definitely didn't break structure. So, yeah, that kind of looks like it could just be an ABC pullback within a downtrend, to be honest with you. Mostly because of my analysis on the other dollar pairs. Oh, wow, yeah, actually, that does. The 30-minute is probably even clearer. Because look at that. 1, 2, 3, 4, 5. 1, 2, 3 down. 1, 2, 3, 4, 5 up. That really looks like an ABC pattern to me. This is probably a wave one. We're probably in a wave two. Maybe it is going to pop up a little bit just to grab some liquidity, but I think down's the direction. Definitely seems like down's the direction, doesn't it? That really looks like a 5-3-5 pattern to me. Traditional ABC. Very traditional. Wow, huh? Does everybody remember the days when the interest rate news would come out and the market would move like even the euro dollar would move like 100 pips in like 2 seconds? What happened to those days? Because that hasn't happened in a long time. It really doesn't even do that anymore, does it? What happened to those days? They're gone. Wow. Ooh, it makes you want to take a nap just looking at these charts. Holy mackerel, huh? Woo. Hopefully Powell or somebody will say something to get these markets moving. I'm gonna keep my limit order on the euro dollar, but I still think there's a good chance it could pick it up and still could do what I think it's gonna do. What did the stock market do over it? Anything? Yeah, it kept pushing down, which is what we thought it would do. Big push today on the stock market, huh? Real big push. Everybody was anticipating the news, and then the news came out and didn't really do much. The markets moved today quite a bit, but they moved like before the news came out. They didn't move at the news. Gold made a really nice push down today. Like I said, if anybody's been watching my videos on gold, every single day I've been saying, look for shorts on gold, look for shorts on gold. Hopefully some people caught that short today because that was a nice short. Could even be possibly on my Saturday video for clearest entry of the week. I don't know. It's really not a very clear entry though, unless you go down to a short time frame maybe. Even then, it's not. I mean, in hindsight, I can see it, but there's your A, right? There's your move up for the A. There's a very, very sideways wave B. There's an impulsive up wave C. There's engulfing down, so your entry was right there. What time did that happen today? That happened at 8 o'clock this morning, London time. So yeah, I mean, it definitely was a beautiful entry on gold today. 8 o'clock this morning, London time. Go short. Get out this afternoon on this higher low right here. One of these higher lows would have been the exit. If you're short and you see a higher low on the time frame you entered on, or if you're long and you see a lower high, then it's probably a good time to get out of the trade. Definitely. So what do we got now? We got 20 624. What do we got tonight? GDP for the Kiwi tonight. And anybody that is available during the Asian session, definitely pay attention to those yen pairs. I think the yen pairs in the Asian session, and maybe even the Aussie pairs in the Asian session, will be where it's at. The Aussie, the Kiwi, and the yen is where it's at today. Probably the dollar's not even going to be the big mover. It's probably going to be the Aussie, Kiwi, and yen that's going to be moving in the Asian session. Notice that I don't even have any of the sort of time frames on my chart. I do that on purpose. I don't want people to think that I'm a scalper. I am not a scalper. I despise scalping. We have a lot of people in my group that do pretty good at it, and I will definitely show you how I would scalp if I was gonna scalp, but I don't scalp. I walk and I do exercise and I don't just sit in front of the computer all day like a scalper potentially would. Even though if you're a good scalper, like we were talking about yesterday in my meeting, if you're a good scalper, you could scalp for, 2 or 3 hours in the London session, London Open, the first 2 or 3 hours London Open, and then scalp for maybe 2 or 3 hours New York Open. So, maybe scalp for 4 to 6 hours a day, and then that's it. Make your money and you're done for the day. So if I was a scalper, that's definitely what I would do. I'd probably do the first 2 hours of London, first 2 hours of New York, trade for 4 to 5 hours a day, and then I'd be done for the rest of the day. So I'd literally work 4 to 5 hours a day. That'd be it. So that is one benefit of scalping, I think, because even if you only make like $200 a day, that potentially is like $2,000 to $3,000 a month, and then add a zero on there once you build your account a little bit. Potentially, you can make A lot of money. Working maybe 3, 4, 5 hours a day. Kind of a boring FOMC. So hopefully you saw my analysis for that surge. Surgy. For the QE dollar. Sorry about that. I was watching the chats on YouTube. In a couple minutes, we're gonna watch Powell. So I guess there's no more requests. So we'll watch Powell and see what's up with that. We got a couple minutes until that starts. Can everybody hear the music that's playing right now? Put a little yes in there if you can. I always am confused whether people can hear what I hear. I'm no audio expert, and I'm definitely no live stream expert. I'm a trader, not a computer expert, that's for sure. Can you hear the music? Yes? Which means that you'll be able to hear Powell talking when he comes on? Definitely could. Do you guys hear that music that was just playing a second ago? Just because I want to make sure that everybody can hear when Powell starts talking. I can hear it in my headphones, but I'm not really sure if you guys can hear it through the desktop, through the live stream. Oops. I would kind of hoping that is what happens. It'd be nice to see some moves, other than like random times during the day when Trump talks about something that's going on in the Middle East, something happens, something random happens when there's nothing, potentially nothing's supposed to happen, but all of a sudden, bam, the market just moves. I miss the old days when the market used to move around news, like the scheduled news events. The market used to move these times of the day, not just some random time of the day when Trump is like talking and then it just takes off and makes like a 300 pip move just because Trump said something about something important. Somebody let me know if you can hear this music, please. So that way I know that you can hear Powell. If you're on YouTube, let me know if you can hear this music. 'Cause I never know. About to start. Yeah, it works. Good. I think you guys can hear it. Here we go. There he is.
Good
do the
afternoon.
split screen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow.
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually, and it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Timoros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices are the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued. What we want to see for this year, rather, is continued progress on housing services. Finally seeing that the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see, but it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew. Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure, and it's just a very different thing and a much more difficult thing because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
I was just one question there, but follow-up would be there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, Committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures. Index was super high. Add them together, you get the misery index, and that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting. And usually we do, but in this case we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing. It's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built based on the history that they're seeing of tariffs coming through into prices. They can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly, but people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, the maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices, So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Okay, it is over. Everybody enjoy the show? Okay. Pretty decent moves. Tell you the truth, I was hoping for a little bit of a liquidity grab. I put my limit order right there on the dollar. Normally, I don't even really trade these news events anymore because, in my opinion, sometimes you hit it big, sometimes you don't. Your trading business needs to be a business, not like going to the casino. So, you don't really want to try to hit it big like you go to the casino. You want to have a trading plan, trading business. So I put a limit order right there, didn't pick it up, not too big of a deal because we definitely have a bigger structure and we definitely can continue to look for pullback entries from this point forward. So hopefully everybody just saw what I was doing there for a few minutes while I was listening to the Powell speech because it was kind of boring. Now, every single morning at the beginning of London session, I give you my 1 hour bias if you're a premium member on my website. So here's my 1 hour bias. Every single morning I do that, and then in the afternoon during the New York session, I do it again. So before this news came out, we had this break of structure to the downside. Then I had my biases down this afternoon, which you can see on my timestamp. If I pull this up, I'll show a little example of what I'm talking about here. It looks awful simple in hindsight, and I'll be the first person to admit that hindsight trading is simple, but here's the 1 hour time frame. I saw the break of structure. This is what I posted this afternoon as the pullback was starting. I said looking for shorts. So I do this every single morning for all of these pairs on this list, and then I do it every single afternoon in late New York session, usually right around 4 or 5 p.m. UK time. And it tells you my bias. So before the pullback even started on the pound dollar this morning, I said down. Aussie dollar, I said down. US dollar CAD, I said up. US dollar Swiss, I said down. Gold was obviously down for days now. I've been saying in my videos. Dollar yen was up. Euro yen was up. Pound yen, we're looking for longs, I said this morning. And this was timestamped at 3 o'clock this afternoon, which was about 4 hours ago. CAD yen, we were looking for longs. CAD Swiss, we were looking for shorts, which that obviously broke structure, so now we're looking for longs. Yo Aussie, for some reason that one didn't go through, I apologize. And the US dollar Swiss, we were, not the Dow Jones, we're looking for shorts. And the UK 100, we were looking for shorts. Now, when I was just going through there, you can see the timestamp on there. This was the euro dollar. I said look for shorts. Look at that little zigzag. There's your break of structure. There's your sorting opportunity. Go short the euro dollar. Move on to the pound dollar. Break a structure to the downside. Pull back right here. Three-way pullback. Sorting opportunity right there. Sort. This was provided hours ago to all my premium members. Anybody that signed up to my website, fxpipcollector.com. Aussie dollar. This afternoon, I posted shorts on the Aussie dollar. Break a structure. Here's your pullback entry. Throw your Fibonacci retracement on there. And there's another sorting opportunity right there. Called 3-4 hours ago. US dollar CAD, as you just saw, I was recommending longs all day long. If you're a real short time frame trader, you potentially could have got 3 longs out of this thing today, potentially. US dollar Swiss, there really wasn't much of an entry on the dollar Swiss because unless you were on maybe the 5-minute, there definitely was a little zigzag right there on the 5-minute. But anything above that, you probably wouldn't have caught that one. Gold, I've been recommending shorts every day. If you've been watching my videos, I said that this was the structure. We should be short, 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 short. We should have been short, and we should be short, and we should be short. And we should still be looking for shorts on pullbacks, right? This was something that every single morning, twice a day, I've been saying look for shorts to all my premium members. My bias, twice a day. US dollar yen was a nice one. We had a break of structure. We had a little zigzag right there. Maybe 15-minute would have been a little better to see it, but bam, nice sorting up. Nice long right there. Called hours ago. Ever since we had a break of structure right here, I've been calling long. So long, 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 and long. Potentially you could have gone long in there someplace. Maybe you had a losing trade. If you did, not that big of a deal, is it? Pound yen. Ever since we broke structure right here, I've been recommending longs every single morning to my premium members at 9 a.m. in London time and at 3-4 in the afternoon New York time. And yeah, ever since this break of structure, long, 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 potentially long this afternoon. Aussie yen was kind of messy. Actually, no, Aussie yen was nice. Ever since this break right here, we've been long, so every pullback from that point forward, ever since this break right here, we've been looking for shorts, which it gave us the first short just recently, about an hour and a half ago. And the CAD yen, there's your break of structure, there's your pullback right there, there's a continuation pattern, potentially better on a little bit of a shorter time frame. Swiss yen, we've been looking for longs on the Swiss yen ever since this break of structure, so we're potential long there, potential long there. Now we have a break of structure to the downside, which means that we should be looking for shorts to the downside, right? It's not really anything too difficult. You don't really need any indicators. You don't really need a whole lot of early wave knowledge, even though early wave knowledge definitely helps. There's your break of structure. There's your pullback entry right there on the Euro Aussie today. Beautiful trade right there. Pound Aussie, there's your break of structure. None of these counted as structures because none of them made a new low, so that break of structure had to have been right here. There's your break of structure. There's your pullback entry. There's your long. US 30. I removed my break of structure just recently, but the break of structure was right here. So potentially we would have tried to go long someplace in here, potentially long in here somewhere. Now we got a short we should be looking for pullback entries to go short from this point forward. So definitely shorts from that point forward. And the UK 100, we were looking for longs ever since these breaks of structure. So potential first long was there, second long there, another long there, another long there. Now we have a nice clear break of structure. We should be looking for a decent pullback in order to go short. These little zigzag pullbacks might be okay on like the 5 minute or something, but maybe 30 minute, 1 hour time frame trades are these ones right here, definitely. And like I said, every single one of these was provided hours ago. You can say I just went through my bias on every single one of these. I do this at 8 to 9 o'clock London time in the morning, and I do it again at 3, 4 o'clock in the afternoon, London time. So twice a day. Plus, I give you my daily analysis, my weekly analysis once a week, and my monthly analysis once a month. So you get the monthly, weekly, daily, full top-down analysis is very important. And then twice a day, you get the 1 hour analysis telling you what threats and structures telling you to look for trades in. So if anybody is interested in that, you definitely check out my website. It is very, very cheap. I always charge $30 a month. You can follow along with my trades too if you want. Every single trade I take, I do stay with the group at the exact time of entry, but I definitely prefer when people take the effort to try to learn how to trade and not just follow along with somebody else's trades. So definitely check out my website, fxcryptoactor.com, if you're interested in that. Very, very cheap membership because just like everybody else, I want to get rich off my trading, not my membership. That's why I keep it $30 a month. So anyways, that's it for now. I'm going to make my PM videos. You can sign up for my PM videos also now for $8 a month if you're only interested in seeing that. Every weekday night, I make a video for the euro dollar, the pound dollar, the US dollar yen, and gold. Last year, I had so many people telling me that I give away everything for free that I finally decided to make it $8 a month if you want the PM videos. If you're just happy with seeing one video per weekday, you can just not pay anything and watch the morning video, and that's just fine. I do really enjoy helping people, so not a problem with that whatsoever. But if you don't care about the website and you just want to join for the videos, then $8 a month will get you that on YouTube if you join the YouTube membership. If you join the premium membership on my website, it comes with the videos. I just posted them on Discord because it's easier that way. So the videos each night get posted on Discord for you for free, included with that $30 a month. So definitely worth the money. So anyways, I'm going to make my PM videos for that here in a few minutes. And then as always, I hope everybody is doing good. And as always, thank you for watching and happy trading to everyone.